let us continue about allowance methods of accounting for bad debts. At the end of the accounting period, okay, before the accounting record are closed and financial statements are prepared, we perform adjusting entry. You still remember when we do our AK 111, we perform adjusting entry. For example, for prepaid insurance, for supplies, for depreciations, yeah, for any payable, any receivable. So we perform adjusting entry to make sure the figure reported in the income statement, balance sheet is the correct figure. We follow the accrual concept. We want to make sure we match the revenue, okay, and expenses that come from the same accounting period, fiscal year. So we need to perform this estimation before we close our accounts or before we prepare our final accounts. So we need to estimate. This is not the correct value. This is just estimation. We try to come up with the best estimation on the amount from the account receivable that is expected to be uncollectibles. From our account receivable, example 80,000, what is the amount that we expect going to be uncollectible, or in accounting term is doubtful debt. So an adjusting entry is prepared with debit to bad debt expense account and credit to account, we call it as allowance for doubtful debt. This bad debt expense is your expenses, expense and is your expense accounts. It go to your income statement. This is debit, all right? Debit. And allowance for doubtful debt is a contra account receivable accounts. Mean account receivable is debit, allowance will be credit. Same like your accumulated depreciation. So this is the process how we're going to provide estimation on the doubtful debt. So what is allowance for doubtful debt? Any debit or credit to account receivable control require a like debit or credit to one or more of the subsidiary ledgers account. So this is the process we're going to use allowance for doubtful debt accounts. So a direct credit to account receivable control will produce an imbalance between it and the account receivable subsidiary ledger, therefore destroying an important element of internal control. Let me explain what is account receivable control accounts. Okay. Normally in business, we have this account receivable control, AR, AR control. This is the main accounts. But businesses, we don't sell only to one customer. We have 100 or 1,000 customers. So for every customer, we have a separate account for them. For example, this one, AR, QPUSIN. Okay. This one, AR, for Marine. Okay. This one, AR, for Achol. Okay. So this is the small account, the subsidiary ledgers. At the end of the day, we are going to total up all the balance, and put it in our account receivable control account. So the total of account receivable balance should be the total of all the subsidiary ledgers, the small ledgers. So we don't want to adjust these small accounts directly. So what we're going to do is we're going to create another account, call it as allowance for doubtful debt on the other side to reduce your account receivable. So how to estimate doubtful debt? It's very challenging task. It needs experience. Yeah, normally your boss know. Yeah, after so many years working in that industry, they know their customer and they can help you with a good estimation formula on how to determine the bad debts and doubtful debts. The estimate of the amount of doubtful debt is generally based on combination of past experience and forecast of future economic and business condition. If the economy is not good, so please expect that more people will not able to pay their debt. Okay, the goal is to produce a reasonable, it's not accurate, it's reasonable estimates of the amount of account receivable that will be collected eventually in cash. So one method is by using percentage. This is method number one. That is by using percentage. That is percentage of net credit sales method. The logic of this method is that your credit sale produce the account receivable that may become bad debts in the future. Example, I'll give you example. If your credit sales is 100,000, based on your estimation, maybe 3% will turn to bad debts. So your estimation is based on 3% multiplied by 100,000. So this gives you estimation of, this gives you the answer, the doubtful debt of 3,000, 3,000. So this is a method one. Based on the percentage of net credit sales. Net credit sales means sales minus your return. Sales return or return inward. So that is your net sale. Net credit sales. Sale, we have two types. First is your cash sales. We don't count this because we already calculate this. The second one is a credit sale. Credit sales will affect your account receivable. Credit sale will affect your account receivable. Okay. The second method is by preparing the aging of account receivable method. I believe many of you, we had tried to use aging statements when we use Excel, their template during week 2. So by aging, you will able to identify the age of every bill. For example, from 0 to 30. We have a current one category, 0 to 30, 31 to 60, 61 to 90, maybe 90 to 120, 121 to more than 120, more than 120 days, 120 days. So by having this aging, it helps you to estimate the likelihood of that bill will not be able to be collected. That payment will not be able to be collected. For example, most likely, the longer the period here, the aging, the higher probability that you're not able to collect the money. If that guy have not paid you for more than 3 months or 4 months, most likely we're not going to collect the money. Because that is the probability. The probability is very high. Okay. So the past accounting record are therefore analyzed to determine the approximate percentage of each group that will become bad debt. So you come up with estimation, maybe this group, the bad debt may be 1%. The second group is 2%. This one is 3%. And the 90 to 1, maybe you have 90, more than 90%, 90 days. This one maybe probability is 50%. So you are using the percentage technique to determine your doubtful debt. So how are we going to write off bad debts? When an account receivable is determined to be bad debt, we need to write off the amount from our accounts. So how you're going to do that? You're going to debit your allowance for doubtful debt accounts. This is bad debts mean confirm. Confirm. Okay, the previous one is doubtful debt based on estimations. This one, when you confirm, you're going to reduce your allowance for doubtful debt. Okay, if there is any GST, since we're not using any GST in our example, and then you're going to credit your account receivable control accounts. You're going to credit your account receivable control account. So you're going to reduce your account receivable. This is your account receivable. So when you credit your account receivable directly, your allowance, your amount of account receivable will reduce. So this is the process. AFDD is allowance for doubtful debt. This one you're going to debit. You're going to reduce your estimation, and then you're going to minus your account receivable. You're going to minus your account receivable. Any question? So when we want to write off bad debts, always remember that we're going to debit our allowance for doubtful debt accounts, and we're going to credit our account receivable. So by doing this, the balance of account receivable will reduce, and the balance of allowance for doubtful debt will also reduce. An adjustment note, complying with GST legislation requirement must be issued. If the country apply GST, so you have to come up with a certain document notes that you're not able to collect the money because it relates with the government tax policy. The amount of money received from the sale, certain percentage should be paid as GST. Certain portion of it. So when we are not able to collect the money, we will need to inform the government. So, but in our context, we're not applying that in our examples. So, the related account in the subsidiary receivable ledger is also credited. We go to that guy, Mr. X account, and close their accounts. Close their accounts. Mean you're going to credit their accounts. In certain instances, there is also the situation that the customer will come back after a very long period of time, okay, and then make a payment to you. This is something unique. Something unique. So in some cases, an account that has been written off, we have already closed the account in part or in full at a later date. Okay, if this occur, the account receivable should be re-established in the account in order to maintain a complete history of the customer activity. You have already cancelled the account, you already closed the accounts, and suddenly this handsome guy come to your shop that and telling you that he's still alive and he has no intention to run away from paying his debt. So he's going to pay. And he said, I'm going to pay tomorrow. Please make sure you are here. Okay. So in that case, you have to open back the file. Go back to his account, and then reinstate the amount. Put back again the amount so you can process the payment. So this is what we call as recovery of an account written off. Another method, we did discuss about allowance for doubtful debt. We provide allowance. We provide provision when we record allowance for doubtful debt. There is also another method. We call it as a direct write-off method. What is direct write-off method? The allowance method is the one that effectively relates to expense to income and is the method mostly widely used. Some small business entity use a different method. We call it as direct write-off method. In this method, no allowance is made for expected bad debt. So they don't have this doubtful debt or expected bad debt, and only actual bad debts are charged to expense. They don't provide allowances, but they record the actual bad debt. At that time, account is determined to be uncollectible. So this is a method number 2. But it's not widely used. The most common practice is we're going to provide some provision, some allowance what are the percentage of item based on the percentage of net sale, based on the aging report, what is the percentage, what is the amount that fall under doubtful debt. Okay, so under direct method, this is done by debiting bad debt expense and crediting account receivable control. So we have two methods. Number one is allowance method. Second one is a direct method. Under direct method, what you're going to do, this is your AR accounts. You're going to credit your AR accounts and you're going to record your bad debts. So this is happen only when you confirm that the customer will not pay you. So this fall under expense. This is your expense. Under allowance, when you every year you're going to prepare your bad debt expense, you're going to debit your bad debt expense, you're going to credit your allowance for doubtful debt. Yeah. Okay. And then when it confirmed, you're going to record in your account receivable credit, and your allowance for doubtful debt here, you're going to debit. Yeah. This is step number one. This is step number two. Number two. So this is different between allowance and direct write-off method.